Okay, I'm going to go ahead and get started. Hello and welcome, everyone. Thank you for joining us today. We might have a few people joining as we get started. My name is Andrea King, and I'm the Executive Director of Plan Giving and Foundation Operations at the Swedish Foundation. The foundation raises funds to support the mission of Swedish Health Services, which is the largest nonprofit healthcare system in Washington State. I want to say thank you to those of you on the call today who are donors to the foundation. Without your support, we cannot continue the innovative work we do every day for our patients here at Swedish. Today is the first in a series of educational programs that we'll be offering about charitable giving, and we'll be continuing these into 2025. So I hope you can join us in the future as well. Now I have the pleasure of introducing Sarah Szabo of the Swedish Foundation and Natalie Pond of Seattle Foundation. And thank you very much for joining us.
Thank you so much, Andrea. And as Andrea said, thank you all so much for joining us today. If you have any issues hearing the audio, please dial 253-205-0468 on your phone, and the web ID is 838-0089-4581. And you can find all this information in the chat if you have issues later in the presentation. If you are having issues with viewing, hearing the call, and you're just not able to resolve, please email foundationevents@swedish.org, and we'll be with you right away to address the issue. This event is being recorded, so you will be able to view it later. So if you have to hop off for any reason, don't worry, we've got you. We'll have it available for viewing, or if you want to just watch it again. And if you turn your video on during it, you'll be part of the video. We have about a 30-minute presentation today, followed by 30 minutes of Q&A. So we will have you out of here by 1 p.m. All right, so I know it can feel awkward, especially in a virtual environment, to ask questions, but I promise you that if you have a question, someone else has the exact same question. So you can raise your virtual hand, you can come off mute and ask your question anytime during the presentation, and you can also drop your question in the chat to Event Questions, and my wonderful colleague will ask your question for you. If you are dialing into the call, you can press *6 on your dial pad to mute or unmute yourself, or raise and lower your hand by pressing *9 on your dial pad. Okay, we're done with our virtual housekeeping, so let's get going. So over the next 30 minutes, we're going to be covering the following items. We're going to review some key terms. Then we're going to do a broader review of the tax considerations that we're addressing here today with this presentation. Then we're going to ask these 3 questions. Why would you donate Appreciate Assets? For any reason? What are the ways you can donate through your IRA, your retirement account? And what's a donor advised fund? How do you use it? And when would it be the right time? All right, let's get going. So we'll start with the key terms. I know there's so much jargon around taxes and finance, so I'd like to just put them forward in the beginning so we can all feel confident going into this conversation. All that being said, if later in the presentation there's another term that you think should be on this slide, please let me know. I am always learning and trying to make this a better experience for everyone. So I'll kick it off. First on our list is just appreciated assets. We'll be saying this term a lot through the presentation, and the real word we need to focus on is appreciation. So appreciation is simply the growth in the value of your asset. So let's have an example. Say you were lucky, you bought your home a couple decades ago for $100,000, and currently the value of that house is $1 million. Your home has grown in value $900,000. So that is the appreciation of your home, which is, for a lot of people, the most valuable asset that they own. So when we talk about appreciated assets, it's simply put, any asset you own that has increased in value. There. The next one, cost basis, is one that I think is very confusing for most people. And all we need to know about cost basis is it is just simply the original purchase price of an asset. So in our home example, you bought your home for $100,000. It's now worth $1 million. The original price was $100,000. That is the cost basis of your home, this asset. So we got that covered. I'm going to throw it to Natalie to talk to us about different types of assets.
Excellent. Thanks, Sarah. And hello, everyone. It's so lovely to be here from Seattle Foundation today, talking a little bit about tax smart giving. I'm going to go ahead and talk a little bit first about this concept of liquid and illiquid assets. So a liquid asset is basically cash on hand or an asset that can easily be converted into cash. Think cash equivalents, short-term bonds, marketable securities. On the other hand, an illiquid asset is an asset that cannot be easily sold quickly or an asset that could be sold in the moment but at a significant loss. So there's not really a bright line definition here, but an illiquid asset might be something like fine jewelry, where it's worth something but potentially very tricky to sell, or a mutual fund, which can be valuable, but there are often restrictions on selling it, or even real estate, again, which can be incredibly valuable. And as Sarah was talking about, really appreciated, even if you've lived in this region for a long time. But it's still an asset that can have complications with selling it. It's not a quick, you can't sell a house overnight. I mean, at some points in Seattle you can, but just thinking about the barriers that go into selling it, it's not quickly converted into cash per se, which puts it on the more illiquid side of things. And all of this points towards the fact that, the liquid illiquid distinction is not a legal definition. It's not a technical definition, but it's sort of a way to understand your assets on a continuum from easy to sell and valuable to maybe harder to sell and potentially sensitive to loss of value if converted into cash at a particular moment in time. The next concept or key term that I want to talk about is this concept of a windfall, and how that applies in this topic of using charitable giving to be tax smart. Again, the idea of a windfall is not a legal definition. It's sort of a like, you know it if you see it. So a windfall is when you either expectedly or unexpectedly have a large influx of income, which can impact your tax status. So for example, you could have a large inheritance. There could be the sale of a business. So these are things that you could both plan for and not plan for, as happens in life. I also want to just touch on, you could have a windfall related to assets that you don't necessarily report as income in the moment, but would have an impact if you chose to sell. For example, appreciated stock that has grown in value or maybe vested after a certain number of years that you've had with a company or at the time of retirement. And there are new considerations there around capital gains tax on sale of those appreciated assets. And so again, thinking about windfalls, not just as large amounts of cash that might come your way, but also navigating what to do with these more appreciated assets and as they grow in value over time. Windfall moments are, I think, also an important time to think about how charitable giving planning can intersect with your tax and financial planning. So like many things in life, having a plan means that you can be really thoughtful and intentional and feel good about the use of your assets rather than maybe not doing anything and coming away feeling mixed about the outcomes, which could include a large tax bill, for example. I've touched on this a little bit already, but just want to dive really quickly into capital gains. The concept of a capital gain is basically the idea that if you sell a capital asset for more than its original purchase price. So typically when we're thinking about capital assets, we're thinking of stocks and bonds, but could also include things like real estate, jewelry, art, and precious metals even. There is both a federal capital gains tax and a state capital gains. We won't go into all the details around, kind of how that breaks out as far as the numbers, but I think it's important to know that both exist. And I think it's also important to mention the concept of a short-term capital gains tax versus a long-term. So a short-term gain or tax, I should say, would be for an asset that you sell after owning it for less than a year, and long-term would be for more than a year. So that's that distinction there, and can play out differently depending on what assets you hold in your individual circumstances. Finally, I just want to mention, we've had this recent update with the Washington state capital gains related to the election. So in the most recent election, Washington voters did reject ballot initiative I-2109, which would have repealed the state's 7% capital gains. Again, we won't go into much more detail here about how that breaks out, but just want to mention that as like a recent kind of in the news update that has some relevance into some topics we're going to talk about later in the presentation. Finally, I do just want to really quickly touch on the concept of gifting and how that applies in the context of some of the topics we're going to be talking about. And to understand the concept of gifting, it's important to think about the estate tax concept. And estate taxes basically work in a way where you're taxed on the total value of the estate. So in other words, the larger the estate, the larger the tax basis. And one strategy that many consider to navigate this is this idea of gifting. And I can talk a little bit more about, Sarah actually talks about this concept of what the estate taxes are in the first place.
Fantastic. So we are transitioned to the tax considerations, which Natalie's touched on a little bit. We put it all here on the slide, so if you see these and watch it later, you've got it. But the basic things we'll cover are estate taxes and touch a little bit on Washington State capital gains. So first things first, always, Nala and I are not CPAs, we are not financial planners, and we are not estate attorneys. So we're just going to give you a broad overview. And if anything we say just kind of flags for you as something that you're like, that might be something I really need to know more about, or this might be a consideration for me now or in the future, I absolutely promise you, your advisor has their eagle eyes on this all the time, because these are changing all the time, and are very happy to discuss them with you. And if you don't currently have an advisor, our team would be more than happy to refer you to an advisor that can address all of these issues and questions for you personally. You're a very specific situation. So first things first, estate tax. Currently in 2024, the federal estate tax exemption is $13.61 million per person, which means if you are part of a couple, $27.22 million. And what the exemption means is that your estate can be up to this amount without getting taxed. So if your estate currently is above this amount, this exemption will hit you for the amount of your estate that's over it. Everything under 13.61 million is exempt from tax. Everything over it will be taxable. And this is set to run out in the end of 2025. So like I said, your advisors, everyone will be tracking whether this is changing. Will it go up? Will it go down? I do think when this changes, it will be news that you will hear about, but I promise you, your advisors will know about it when it happens and address it with you. In Washington State, our estate tax exemption is much lower. It's $2.193 million per person, double for a couple. And this has stayed the same for quite a while. For about 8 years, it's been the same. If this changes, it's likely to go up. I do not know that that is in the future, but if it was going to catch up for inflation, it would be rising, not lowering. So there is a scenario. These are pretty big numbers, a wide gap between these two numbers. You could have an estate that would have some Washington State capital gains and not federal, sorry, Washington State estate taxes and not federal estate taxes. So that's pretty common. The other thing I always like to mention when we talk about estate taxes is what is part of your estate. And I like to talk about this because in conversations I've had with donors, they have said things like, well, this doesn't go through probate, so it's not part of my estate. And in Washington and on the West Coast with us, we are very aware that the probate process, which is what happens to finalize your estate, all your wishes of your estate after you pass, that process is pretty bad in California. Everyone knows it's bad. A lot of people use living trusts very intentionally to avoid that in California. In Washington State, we actually have a pretty good and fluid and easy estate process or probate process. But because people are very concerned about probate, they really know that there are certain assets that aren't touched by probate. And two of the biggest ones that you may be familiar with are your retirement assets and life insurance. So those are two assets that do not pass through probate. Which is why you need beneficiaries for those. We'll always pitch that, like, because that's the way they know how to distribute those assets, but they are part of your full estate. So when we're thinking about getting to these numbers in Washington State, that $2.193 million per person, they will count your retirement assets and any life insurance you have as part of your estate, as part of being taxable as part of the estate. So I just always like to talk about that the large full net worth of your estate is what this number is talking about. It has nothing to do with, is it probate? Is it a non-probate asset? They don't care. They want that big number. So for Washington State capital gains, as Natalie said, this started in 2023. It is here to stay. So we'll touch on it a little bit here. There has always been a federal capital gains that has existed for a very long time. And now in Washington State, we have an additional one, just like our estate tax. As Natalie said, 7% on our long-term capital gains, meaning assets we've owned for over a year, but we also have a $250,000 annual exemption. So you can, if your gains are less in a year than $250,000, you do not have to pay the Washington state capital gains on them. And one of the biggest things that came right out of the gate that people were very eager to know about were there any assets that were excluded from this? And to the delight of every homeowner in the Seattle area, real estate was excluded from that. So your primary residence is not touched by Washington state capital gains currently. So since that is likely the biggest asset you own and that you will be passing in your estate, you don't need to worry about it. It is not touched by Washington state capital gains. Your IRA assets are also not touched by this, and the interest in qualified family-owned small businesses isn't either. So if you or your family are part of that, that third one would be a really good question to ask your CPA to see, or do we qualify as being one of the exempt small family-owned businesses, because those generally pass through generations. So that would be another good one to flag. And Natalie's gonna tell us about gifting.
Yeah, absolutely. So I mentioned this a little bit earlier in the key terms, and so we're kind of circling back here to explain a little bit more about what that is and why we're including it here. Obviously, this presentation is on the concept of charitable giving, but when thinking about navigating estate taxes and just kind of thinking about being planful, working with your advisory team, one thing to think about is this idea of gifts to people. And so currently the annual exclusion, the federal annual exclusion for gifting to people is 18,000 per person. And actually the couple limit can be double that. So what's that? 36,000 math. So that's something to keep in mind because again, if you're thinking about sort of looking at that body of your estate and thinking about how to kind of maybe lower that number during the lifetime, during your lifetime, and seeing maybe some of that impact go directly to beneficiaries now, that's a really cool thing to think about and something to talk about with your advisory team as you're thinking again about being planful around some of these estate taxes.
So we'll stop for a second. Does anyone have any questions from these last two slides that we can address?
We did have something in the chat mentioning that I believe they're referring to the Washington state capital gains is 262,000 per year now.
Oh,
I
okay.
don't know if you have any information regarding that.
I will look into that. Last I checked I saw 250, but thank you for that correction. Anything else? But once again, the reason that you need to talk to your advisors and your tax professionals about all of these concepts, because they change annually. Generally, they go up annually. So, all right, we'll move on. All right, so now we come to our first big question. Why do you donate appreciated assets? And the very simple answer to that is to avoid capital gains. So we can just end this now, but no, we won't. We have a really basic chart here that I think is good to just kind of go through step by step that shows two options. We're going to use stock as our example for an appreciated asset in this particular case. They are one of the most common assets, appreciated assets that are donated. So it works well. So in one case, you have your stock, and you can sell the stock and donate the proceeds, or option B, which is donate the stock directly to a nonprofit. So as we've learned in this example, we have a stock that the cost basis $5,000. That is the original price that we paid for this group of stock. Currently, the stock is valued at $10,000. So it has appreciated during this time you've owned it. The gain on that is $5,000. So that is the increase, that is the appreciation of your stock is $5,000. And that is the amount that is subject to capital gains tax. In this example, it's saying the tax would be about $1,200, leaving you a value of about $8,785 to donate to the nonprofit of your choice. Other plan, option B, is that everything else is equal, you donate that stock directly to the nonprofit of your choice, and they receive the full face value of $10,000. You also receive the full face value of $10,000 for your charitable deduction if you are someone who itemizes, and that is for your stock charitable deduction. And option A, you also will receive the charitable deduction as a cash gift, but it will be less. So you can see that there are some advantages to donating your appreciated assets because you completely remove capital gains, you get a bigger charitable deduction option for yourself. The other question that I get from folks is like, well, I see that, I understand this value, but what if I just have the cash in hand? So, I mean, if I save diligently, I always have my part of my paychecks I save every year to make gifts with. If I have that, why would I bother with the stock? So let's say in this example, our donor has $10,000 of cash that he's excited to donate, and he also has assets. He has this great stock that he loves that is also valued at $10,000. What would be the rationale for this person to donate the stock instead of the cash? So here's the thought on that. Is that absolutely cash is an easier thing to donate. It's always easier. Write a check, use your credit card. We do it all the time. Stock is, after cash, one of the other easiest things to do when it comes to donation. It does involve your broker, another person being involved in the process, but it also is very simple. So it's a little more complicated than cash, but barely. But in this state, your broker might be telling you, we love this stock. It has done amazing for us. I think it's going to continue to do great. We definitely want to hold on to this asset. So you might be thinking, there's no way I want to donate this. But imagine this. So you decide to donate. You're like, I'm making this $10,000 gift. If you donate that stock today at $10,000, it comes through $10,000 charitable deduction for you, and use that cash you have to rebuy that stock immediately. What is the benefit of that? It's that now this stock that you love, that you know is going to keep appreciating and be doing really well, now has a cost basis or original purchase price of $10,000 instead of $5,000. So as you keep it and as it works for you over the next 10 years and increases even more in value, and then you need to pull it out to pay for your kids to go to college, to do other things, and you're going to have to take the capital gains ding on it, you will take less of a ding because you have increased the cost basis original purchase price to $10,000 instead of its original price of $5,000. So there's some tax savvy ways of utilizing your assets to give you a tax advantage later down the line. I'll stop for a second. Does anyone have questions on this specific topic? Also, to be said, this is generally applicable to all appreciated assets. There's some tangible property that Natalie mentioned that have some other factors that you need to get assessments of value on, but generally speaking, this principle is applicable to all types of appreciated assets you have. Questions? All right. On we go. Okay, so here we go to donations from your IRA, which we will also lovingly say is the start of acronym soup that we have here. So we're going to try really hard to say the full words and not overwhelm you with the acronyms. So some of you may be already in here, you understand how to use your IRA. None of this is new information for you, but some might not be at that stage yet. So we're going to go through some of the basics of just IRAs in general. So you've built your IRA up over your lifetime, diligently through your paycheck. And when you get to the age of 73, the federal government says you are required to take minimum distributions. That is the year that you have to start taking distributions from your IRA. And those distributions that come out to you are taxable. Because when we're talking about these IRAs, we're talking about traditional IRAs. We are not talking about Roth IRAs. That are IRAs that are that you pay with money that has already been taxed, so they come out tax-free. So this is traditional IRAs. Okay, so at 23, you have to start taking these distributions. And most people will say, well, great, that's what the point of this was. I paid into this IRA my whole lifetime so that I could have the income once I retire. If this works one for one, it's worked and we're happy about it. But also, as Natalie was saying earlier, there's other factors that come into your life. You know, maybe you have a partner that you didn't expect to have. Maybe there's an inheritance that comes. There's all kinds of income that can come into your life, some planned, some not planned, that could, in a given year, maybe disrupt a little bit what your income rate, like what income you have, what that large, big bucket of pre-tax income called our adjusted gross income, that first big number on our tax returns that we see, that could have some impacts on us. So what can help us in those moments, what can be one option to help us, are to use some of that required minimum distribution to make a qualified charitable distribution. So beginning at age 70 and a half, which used to be the age you had to start taking your required minimum distributions, which is why that might look a little wonky. When they upped the required minimum distribution age, they left the charitable distribution age alone. So you can technically start doing this before you're required to take any distribution. In 2024, the max distribution you could take for a qualified charitable distribution was $105,000 per person per IRA. So if you and your spouse both have IRAs, you can each take money from your IRAs up to this amount. And the really good thing this offers you is avoiding having taxable income come into your income stream that particular year. This stops a inopportune maybe bump of that adjusted gross income that might put you in a higher tax bracket or do some changes that you're not really wanting. And then the question is, someone says, well, what does it matter if it's a charitable deduction? If I take that, my distribution, I make a deduction, I get the charitable deduction, it all evens out, right? So why go through this process? That is true if you itemize, which not as many people itemize these days, but that would be true. But the one thing to consider is that there are other tax implications to your adjusted gross incomes. This slide mentions here, like your Medicare premiums, certain state taxes and surtaxes that are also impacted by the amount of your adjusted gross income. So if you have a year where there's maybe more income coming in or surprises, or you just are having to sell another asset you might have that's producing income, this can be a really good opportunity or option for you if you don't have the flexibility with your other income streams. And the flexibility year to year is what really makes this a great tax advantage option for you to just kind of keep in your head. You may think, I'm never going to need this, but then the year might come where you think, oh, no, I remember Sarah talking about this. Yeah, we're going to use this. Do you have any questions about this before we roll on to charitable gift annuities? All right, on we go. So this is my final part, and I get to pass the mic back to Natalie. This was another new opportunity that came to us in 2023, was being able to incorporate charitable gift annuities and charitable remainder trusts into your qualified charitable distribution landscape. I'm going to talk really quickly about what that is, and then I'll go into more detail about charitable gift annuities in general. So as of 2023, you can take a portion, not the entire amount of your qualified charitable distribution, to create a charitable gift annuity or a charitable remainder trust. This year, it's $53,000. As with other things, this tends to increase over the years. So like annually, your CPA, your advisors, they will know these amounts and how you can utilize them. And the one really different thing about this is that it is a one-time election. So you can do this one time in your life. This is not an annual option. All right, which also makes it really popular in those years where you might say, oh, I actually do need to get this deduction. What are my options? What do I need? Because I have this influx of additional income that I wasn't expecting. And I can tell you from my experience in 2023 alone, I did 3 of these charitable gift annuities right off the bat. They were incredibly popular. I think with the amount, 53,000, or actually that year it was 50,000, 51,000, and the timing of age. This became something that people could see an opportunity to utilize right away. And we'll talk more about the age timing in a second when I talk more about gift annuities. I have not personally seen this as commonly used to start charitable remainder trusts, but what I will say is that if in the future at a time you're thinking, yeah, charitable remainder trust seems right for me, this is something that I want to do, my family is ready for it, I'm ready for it. This one-time election, if you haven't used it already to do a charitable gift annuity, could be one of the many assets that you put into a charitable remainder trust. And if you haven't used it at that time, it'd just be something to consider as an option. You might be putting in stock and other different assets that this could be your one moment to use it and take advantage of it if you can and want to do that. So I'm going to talk a little just about charitable gift annuities and life income gifts, as they are called in general. So as we see here in our wonderful icon, we have our donors, you, who say, yes, this year I'm going to use up to $53,000 to fund a charitable gift annuity with Swedish, because you're on a Swedish call, but you can do it a lot of different places. And what that ensures is that you have fixed payments for the rest of your life. And this harkens back to why timing is really important when you think about the option of a charitable gift annuity, because the payments are fixed. So if you start or think about, I'll be 40 next year. At 40, what might seem like an advantageous fixed payment might seem less valuable when I am 80 years old because inflation happens. So this becomes a much more popular vehicle for people to use in their mid 70s and older, and the rates are also much better for that because at that point you're probably retired, you're living on a fixed income, and you have a better idea of what you actually need and what is valuable to you in your life. So these become much more popular vehicles in general when people are past retirement age. So at the end of this, after you've passed, whatever is remaining in this account, because you get paid fixed incomes no matter what the market is doing, you get the same amount of money every quarter, every month, depending how you set it up. The remainder returns to the nonprofit in which you set it up, which in this case would be the Swedish Foundation. And this might bear the question, you're saying, Sarah, you told me in the last slide that the entire point of doing a qualified charitable distribution was to avoid getting taxable income into my pocket. So why now are you telling me that there's an option here that will give me income that's taxable? You are absolutely correct. But the difference is there's a difference between a 53,000 lump sum hitting your income line in 1 year and putting that in a charitable gift annuity and having a couple $1,000s hit your income every year. So it just tends to be more manageable. You get to retain that income. It is not all lost to you. And it's in manageable sums that you can work more easily into your annual income stream without it being kind of a surprise that's dropped in there for you. The other thing I want to mention, this will be my last part, is that this illustration is very specifically talking about a charitable gift annuity funded from a qualified charitable distribution and its tax implications. If you fund a charitable gift annuity with cash, or let's say an unappreciated asset like stock, the cycle, the fixed payments, it's all the same. But when you fund it with an asset like stock or cash that has been taxed already, the tax benefit you get is that there's a certain amount of years where that income is actually tax-free to you. So you're getting two different types of tax advantage from a charitable gift annuity, depending on what you use to fund it with. So if this is flagging for you as something you might be interested in on either side, we'd be happy to talk to you about it and just talk through the different benefits depending on the asset that you're using. So I'll stop for questions. Anyone have any charitable gift annuity questions?
Sarah, do you also get a deduction when you set up a charitable gift annuity?
You absolutely do, Andrea. I completely forgot. When you do set up a gift annuity with your charitable qualified charitable distribution, you do not get a charitable deduction because you're getting that avoidance of the taxable income. When you set it up with your taxable assets like cash or stock, you absolutely, in your first year, you do get a charitable deduction. I am remiss having not mentioned that. Thank you, Andrea. Okay, I will throw it over to Natalie to bring us home with donor advised funds.
Excellent. I always love hearing from Sarah. Sarah's so knowledgeable. So you all know you have a great resource here at Swedish. That's very cool to have that available for figuring out, because there's so many options and figuring out what's right for you can be complicated, but you have great resources, which is great. I'm going to take us home with a little talking about donor advised funds. I think as we touched on early in the presentation, I work at Seattle Foundation, and so part of what I get to do in my role is work with folks who are opening a Seattle Foundation donor advised fund. And it's really a joy to kind of get to work with people figuring out how they want to do their philanthropy, with what assets, what are their impact goals. So I do these every day, and I'm happy to answer questions as we go. So don't feel like you have to save them for the end. Interrupt me at any time. Happy to go deeper on any of the topics that we're going to hit on in this last part of the presentation. So essentially, let's start with the basics. What is a donor advised fund? A donor advised fund, in essence, is a personal giving fund that allows you to make grants out to nonprofits that you want to support. Making a gift to open a donor advised fund or replenish it is tax advantaged, as you can kind of see in this flow chart here. Making a gift of cash, stock, or other assets provides that immediate tax benefit as you go about establishing the fund. And this can be really helpful for managing large tax impacts. We've talked about windfalls. This has come up a few different times, sale of a business, things like that. Again, your CPA is a great resource here to determine, what might work best for your situation, but coming into a large amount of cash that you maybe were not expecting is a great way to think about a time to open a donor advised fund or use one of these other charitable giving tools that we've been chatting about. That stated, DAFs can be opened with a wide range of assets. So we've talked about the concept of using appreciated stock. That's a great place. We see that a lot at the foundation. And DAFs can accept other more complex assets too, like real estate, fine art, jewelry, etc. One thing I will say about that, Seattle Foundation is a provider of donor advised funds. There's also many others. You can get them at a financial institution like a Schwab or a Fidelity. A lot of banks have a DAF model now that you can use. So they're not all the same, I guess, is what I would say. So if you're thinking about using a more complex or illiquid, we might say, asset to fund or replenish funds in your donor advised fund, you should talk to your custodian, the entity that would set up your DAF, and make sure that they can do that. We do complex assets at the foundation all the time. It's kind of our bread and butter. We sort of have a team that's really well equipped to do that, but that's not the case for every custodian. So if you're looking at different options, it's a good question to ask if you're thinking about, again, a more complex or illiquid asset. Once your fund is established, so we've talked about the assets that go into it. Once your fund is established, your funds are invested. So they are invested to grow over time. And again, this looks different depending on which provider you use. But you have typically a few different investment options that you can select from that allows your fund to grow. And then the fun part, the really amazing part, is that from there, you can make grants out to the nonprofits that you care about. So the only sort of restriction on this is that grants out from your DAF need to go to qualified 501c3 organizations, which is an IRS distinction. Most DAF custodians, including Seattle Foundation, well, I should say, all custodians do due diligence around if the nonprofit in question is current with the IRS on their 501c3 standing. Some custodians will also do additional due diligence, depending on the person or the entity that's opening the fund. So that's kind of what DAFs look like at a glance. I'm just making sure, looking at my notes, making sure there's nothing else I wanted to mention about just kind of the structure of DAFs. Does anyone have any questions about the basics of what a DAF is and what it does before we go into a little more detail about why they're great? I think we can maybe go forward then, Sarah. If you think of anything, speak up, folks. All right. I get to have this conversation with folks all the time when they're at the beginning of their journey. So the question is always sort of like, why choose this? I mentioned this already. They're very simple to open and maintain. So you can open as long as you have the right custodian with almost any asset. You can replenish your fund over time and see charitable giving potential grow through your investments. And the other sort of simple to maintain piece of this is that there is not complex administration related to keeping a DAF open, unlike a family foundation, for example. Something we're actually seeing at Seattle Foundation quite often is folks coming to us saying, I've had a family foundation. It's been really meaningful. I love the giving part, but the elements around legal compliance, tax compliance, doing your 990s every year, that can get to be a lot. And so some folks are actually choosing to go from a family foundation to a DAF model, and we're seeing that more and more. So it'll be interesting to see how that evolves, but it is a simpler tool from that perspective, that sort of like administrative burden component. The other reason I think to choose a donor advised fund or DAF is you can do good by giving well. So you can make as many gifts as you would like. There are no distribution requirements for a DAF, unlike a family foundation, which is currently, I believe, 5% is the requirement. But you can still do all of the meaningful things that I think people like about the family foundation model or the idea of giving. So you can involve your family in giving, you can take part in succession planning, you can make legacy gifts through your DAF. So part of what we always talk to folks about when they're setting their DAF up with the Community Foundation is, what is your plan, right? Like, do you want to pass your donor advised fund to children to continue grant making? Would you prefer to do a designated model where after you pass away, the fund is maybe endowed or not endowed, but then goes to specific nonprofits? There's lots of customization options, and I think that's another really meaningful reason to choose a DAF, is it can give you that sort of ability to make a lot of choices that are personal to your situation and your family and your philanthropic goals. And finally, we've touched on this a little bit already, but of course, there's a tax benefit to opening a DAF and replenishing a DAF. You can actually spread out a gift to your DAF and I should say the deduction benefit over up to 5 years. I really strongly recommend seeing your CPA to see if that's a good idea in your circumstance. But again, if you have a large liquidity event that you're looking to manage, spreading it out over 5 years can actually be a really good tool, something to think about. And then of course, there's the potential with this, as with many other tools, of navigating capital gains from appreciated assets. So donating that to a donor advised fund is another way to navigate some of that. I'll pause before we dive into my last slide, which is more about impact. Are there any questions about some of these reasons why someone might choose a DAF for their philanthropy?
I'll also just say that I have friends who have chosen this model as a way to separate their estate into two parts. They have their philanthropic part of their estate that they put at one very big moment into a DAF. In one case, it was the sale of a home. And then the rest of their estate is their non-philanthropic estate. And that's what will go through probate, what will be given, and that is going to their children. So there's another idea at a certain moment where you think, I do want to make these gifts. I can do them through my estate, which is a great thing to do. And then ahead of that, you could also think, maybe I'll put them in a DAF and then set up the model like Natalie was talking about how that philanthropic dollars are used after you're gone. So I just always want to mention that because I think it's a great tool for thinking about your philanthropic and your non-philanthropic estate.
Totally. Thank you. That's so true. It's just a great tool. Okay, I'm gonna close us out here by talking a little bit about the potential impact that could come with having a DAF. I'm going to first tell the story of a wonderful fund holder that we've had at the foundation for many years, Warren. Warren made an initial gift of $250,000 to open his donor advised fund with us more than 30 years ago. So this has been quite a while. Since that time, he's been able to involve 3 generations of donors in his family in doing philanthropy. And they've made $6 million total in grants and counting, and the fund currently has a 5-figure balance with the investment potential there. So it's really this, Warren's story I think is really meaningful because you can kind of see through that you can have generational impact. You can do much more. Like Warren could have made a $250,000 gift at one go 30 years ago to several different organizations. But by choosing to open a donor advised fund, it sort of created all of these opportunities for connection with family, for doing more, and for having potential to continue. Those generations, those younger generations are going to be able to continue to be involved in really meaningful ways for decades to come. So it's that kind of like planting the seed, kind of, is one way to think about it. And all that comes out of that over time is really remarkable. And we get to see that a lot at the Community Foundation, which is very cool. Finally, I just want to mention DAF impact by the numbers. I think sometimes there's a perspective that, DAFs are opened for this tax benefit and then maybe they're just sitting there. Of course, at the Community Foundation, we have a little bit of a different perspective on this because we are actively engaging with folks in grant making all the time. All of our DAF holders have a philanthropic advisor who's sort of in conversation with them about their giving. So, the national landscape has different components than what we see, or sort of what I see every day, I guess, in my work. But what I do know and what we can say, and this is some data from the National Philanthropic Trust, grants from DAFs have actually increased 9% to $52.16 billion, which is a new high, and giving has trended up every year since 2009, including more than doubling in the last 5 years. So I think what we see with DAFs generally is enormous generosity and an enormous ability to create impact. And I think, you know, when we look at this year where overall charitable giving is going down, actually, I think that it's really heartening to me to see the DAF numbers trending this way, because I think it shows that people do have such incredible intention to do good with their giving, and DAFs are a really impactful way to do that. So I'll go ahead and pause there and see if folks either have questions about DAFs or about anything we've talked about today. I think it's that time, unless Sarah, I can't remember. Is there anything else? No, we're good.
It is that time.
Amazing.
So are there any questions people have been holding on to the very end? We are here and ready. I think we have about 15 more minutes left in our time.
Do I get with my financial planner and discuss all of these options of ways of doing it? Or do you have a group that can guide me through what the best way of doing it would be for me?
I think it's a great combination. Here at Swedish, we have lots of resources. So if you came and talked to us, we can, based on what you're telling me, say, I think that these could be some good options for you, but we would always encourage you to talk to your financial planner and your CPA, because they know the nuts and bolts. They know the nuance, you know, they might
Right.
know more about your cost basis, what appreciation that you're thinking about for a very specific asset. So I think what we can do is help you maybe decide that an idea might be good for you. So then you can go and talk to your advisors, and we're happy to be part of that conversation too. We could all come together. We actually love doing that as well, to talk about options at Swedish and also in the other charities that you support.
If no one else has any questions, what I heard you discuss was the Family Foundation, the QCD, the charitable annuity, and the DAF. Was there something else I missed?
We talked about donating through our IRAs. So just making qualified charitable distributions from our IRAs. If
Yeah.
people bear with me, I can slide back to that slide. So is this slide that you can see, and then
That
just
one I saw.
okay, and then just generally like the tax advantage for capital gains when you donate appreciated assets in general. So I think you got most of it.
Okay, so sorry.
No worries. Thank you so much for coming today. It's wonderful to see you.
I've got a question on DAFs. I'm going to go ahead and read the question out loud first, because I don't know if I don't think everyone can see it. And
you.
I'll dive in. Yeah. Okay. So here's the question. In my reading, I've seen vague language around directing gifts where it sounds like the donor's intent might not be followed. Is it a possibility that once the DAF is funded, the donor would not be able to give to 501c3s as desired? Yes. Oh, this is a great question. So the way that a donor advised fund works, and sort of the key word there is advised. When you make the contribution to open your DAF, and this is true at any custodian. So it's true if you look at a community foundation, it's true if you look at a Fidelity or Schwab. Once you have given that money is sort of no longer your money. So the language that it is using is to reflect the fact that you are directing the grant, but it is not your fund specifically to like allocate to. And the term for that is actually called variance power. So it's this idea that once the assets have been handed over, the assets then belong to the entity that has now been given them. You can move DAF providers. So you can say, like, say you opened a DAF at us at Seattle Foundation and you moved and you wanted to transition your fund. You can transition your fund to another DAF provider. It's just that because those funds have been donated for like charitable purpose, they have to retain that structure in order to be compliant with the IRS. So what I will say is I have not seen a situation where if it's a qualified 501c3, the entity, the custodian's not going to decline that. It's just they have to use that language of direct in order to be sort of like legally compliant with what the structure of a donor advised fund is. I will say there are custodians that will do different kinds of due diligence other than 501c3 status. So like, for example, at Seattle Foundation, we have sort of an additional layer of due diligence that we do on top of the 501c3 status. And we will engage in conversation with a fund holder about, if for some reason an organization were to fail that, we would have a conversation about sort of like what what went wrong and kind of like what we would suggest doing. But that's that concept of variance power is why that language is directed as opposed to like you have, I guess, total autonomy over the fund, if that makes sense. I don't know if there's any follow-up related to that question. It's a little bit confusing, but it's basically an IRS thing, and that's where that comes in. So it's like you're directing, but the funds belong to the custodian is essentially the breakdown.
Tax liability language. We love it.
Yeah, totally. I mean, yes. Yes.
With the DAF, basically, that you can direct where the monies go, but they can't go to you.
Do you mean like go to you as into a person
Well,
or
to anything, because you don't own it. You're just directing which
which
donees.
501c3? Yeah, like which nonprofit it can go to. So as
Right,
long
and
as
you
they're a
can-
501c3.
So you can change things, add things, subtract things,
Yes.
but you can't, it's not your money anymore. You can't liquidate.
Right, you can't take it back. You can't be like, I did X amount of money to open this DAF and then I've changed my mind. It's like become a charitable gift. It's essentially the same way that a charitable gift to a nonprofit works in that, like, that's how the IRS sees it. Therefore, it's no longer your money in that way because you've taken that deduction. But yes, you can make gifts to any 501c3 and you can do that at any time. So again, because there's no distribution requirements with a DAF the way there is with a family foundation, you know, you could have 1 year where you make a lot of gifts. You could have a year where you make less. It kind of depends on what your goals and preferences are.
Okay.
Thank you. I will advance us to our final slide and just say we're so happy to have you all here today. If you have any additional questions, if anything pops into your mind following up on this, absolutely please feel to reach out. Any questions, if you need advisor referrals, just let us know. We're here for you. That's what the foundation is here for. As Andrea said, this is the beginning. At the beginning of our session today, this is the start of educational programming that will be coming and more programming coming in 2025. So please stay tuned on that. And thanks again for donors like you who make all of these events and engagement opportunities possible. And I wish you all a great rest of your day.
Thanks, everyone.